Before we begin, a quick heads up. Today, I'm going to be reading out a story for you written by my colleague Anand Kalyanaraman, the finance editor at the Chem. It is sharp, thought provoking, and makes an argument that is hard to ignore. And I think it is worth listening to him in his own words. Anand takes up a bold question that's been coming up quite often in investor conversations. Is China the new US? Chinese markets have delivered the kind of returns investors chase, valuations still look relatively reasonable, and yet, for Indian investors, getting exposure is not so straightforward. And even if it were, how far should they even go? Welcome to Daybreak, a business podcast from the Ken. I'm your host Snigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Today is Tuesday, the 24th of February. The Indian stock market can't seem to make up its mind. The union budget on the 1st of February threw a wet blanket on its enthusiasm. A day later, a trade deal with the US did the opposite. Even so, the benchmark Sensex is struggling to go past its September 2024 high of 85,500, although it briefly crossed that mark in November last year. But across the border, a different script is playing out. Since September 2024, major Chinese indices, Hang Seng Tech, and Shanghai Composite have climbed nearly 50%. Sumit Duseja, the chief executive of private wealth management firm TrueMind Capital, said that the bulls have a long runway there. So far, the US has been the default destination for Indian investors wanting to park their money abroad. Of late, though, a sizable number of them seem willing to go the unconventional route of siding with the dragon. In fact, nearly one-fifth of the about 1,800 respondents to a poll by the Ken said that they would seriously consider opting for China-focused funds or ETFs among non-traditional investment options. Duseja himself had recommended that investors take a 7 to 10% exposure to China-oriented funds. And why not? Besides giving exceptional returns, beating both India and the US markets, stocks in China still command reasonable valuations and have a high growth potential. The Hang Seng trades at a trailing price to earnings of about 13 times compared with Sensex's 22 times and the US S&P 500's 28 times. It helps that the country is Asia's largest and the world's second largest economy. Shubham Agarwal of Aquitas India Consultancy, which runs a Far East fund for the ultra-rich, said, "We were among the most bullish on investing in China a year and a half back. I think China still provides the opportunity." But tapping this is easier said than done. Access to the Chinese markets is restricted for most retail investors and policy risks always lurk. While the likes of Axis and Edelweiss offer China-focused funds, the market's idiosyncrasies and pitfalls keep many away, like the value investor Parag Parikh fund. You'd rather be safe than sorry, the fund house's chief investment officer Rajiv Thakkar said in its annual general meeting in November, referring to investing in China. The country may be beckoning investors, but the risks mean that even its advocates don't recommend going overboard, with China being China, as one fund manager put it. The China opportunity. US President Donald Trump's tantrums, tariff wars, and threats have ironically benefited the country he sees as the US's primary rival and seeks to undermine the most. China ended 2025 with a record $1.2 trillion in trade surplus. With diversification beyond the US, its economy grew 5% and domestic weakness was offset by export growth. The heads of several countries, from France's Emmanuel Macron to Canada's Mark Carney and the UK's Keir Starmer, have made a beeline for China, quickly inking trade deals with it. Trump himself might visit Beijing in April. It seems stocks there are reflecting that optimism. But this follows a long period of pain, even as other markets were booming. From 2021 to 2024, Chinese stocks were pummeled by a perfect storm. Tight COVID control measures that squeezed the economy, cutthroat competition that shrank companies' profits, the real estate meltdown, and the government's crackdown on many businesses in pursuit of common prosperity. It took time for the tide to turn. By the end of 2024, pandemic controls had eased. There were far more stimulus measures and favorable business narratives, and campaigns like quote unquote anti involution prioritized profitable growth, resulting in the ongoing bull run. The country also leveraged its dominance in rare earth minerals to its advantage. Yet, the 5 year return is still negative, said Niranjan Avasti, Senior Vice President at Edelweiss Mutual Fund, which has a 16-year-old China focused scheme that manages assets worth over 2,500 crore rupees. This is unlike markets in the US and India, where indices are at much higher levels than they were in 2021. Besides, despite comparable or stronger growth expectations, Chinese equity valuations remain materially below global peers, noted the 2026 China Outlook report by Mirae Asset Mutual Fund, which also runs a China focused fund for Indian investors. And Avasti says this presents investing opportunities. For instance, Chinese companies such as internet servicing firm Baidu, semiconductor foundry SMIC, multinational conglomerates Alibaba and Tencent, and EV maker BYD, among others, have held their own or even done better against US dominance. These and other giants, such as the tech firm Meituan and consumer electronics company Xiaomi, form part of the Hang Seng Tech Index. Here too, despite the rally, the index trades at 25 times price to earnings, much lower than the over 30 times valuation that the US based tech heavy NASDAQ index commands. With, without, or despite Trump, Indians investing abroad have predominantly opted for US stocks, especially the Mag 7, and that might well continue. Along with this, Chinese stocks can add value to the portfolio as a tactical position now, said Mirae Asset Siddharth Srivastav, who heads the fund houses ETF products and manages its international schemes. Returns from these stocks are also better considering that in 2025 the Indian rupee fell against both the Chinese yuan and the Hong Kong dollar, he added. The trouble, though, is that Indians looking to shop in China will find themselves limited to very few choices, most of which are suboptimal for retail investors. Limited avenues. Most Indian equity investors have exposure to only Indian stocks, inducing a concentration risk that comes with a home bias. Besides hedging against the continuing rupee depreciation, investing abroad opens access to several new age businesses that may otherwise be unavailable in India. And taking the mutual fund route is the simplest and the most cost effective way for retail investors to do that. More than 2 dozen funds allow investors to bet on US stocks. As of December, the top 5 of these alone manage assets worth about 30,000 crore rupees. For China, though, there are only 4 options. The total AUM of these funds is less than 6,000 crore rupees. Of them, Nippon India's 16-year-old Hang Seng ETF and Mirae Asset's Hang Seng Tech ETF, launched in 2021, are shut for fresh investments. In early 2022, the market regulator SEBI stopped mutual funds from investing in overseas stocks as they were close to breaching the $7 million limit set by the Reserve Bank of India. The Ken previously wrote about it as well. I'll add the link to the show notes of this episode. The limit has not been increased since, despite several requests from the mutual fund industry. In effect, only 2 mutual fund schemes, the Greater China Equity Fund from Axis MF, which has an AUM of nearly 17,000 crore rupees, and the Greater China Equity Offshore Fund from Edelweiss MF, which has an AUM of over 2,500 crore rupees, now accept fresh investments. But here too, the latter has stopped lump sum investments and restricted SIPs to 5,000 rupees a month, making the Axis scheme the only one open for investors without restrictions. Both the schemes are feeder fund of funds, or FOFs, that route investor money to schemes listed abroad, which in turn invest in stocks across mainland China, Hong Kong, and Taiwan. So, even stocks like that of leading chipmaker Taiwan Semiconductor Manufacturing Company form a part of their portfolio along with the Hong Kong and China listed stocks such as Tencent, Alibaba, Delta Electronics, and others. Both these actively managed Axis and Edelweiss schemes have underperformed their benchmark, the MSCI Golden Dragon Index, on returns according to their December fact sheets. But fund managers have their reasons to go active. active management helps avoid state-owned enterprises that may be subject to higher government interference, said R. Shivakumar, head of product and corporate strategy at Axis Mutual Funds. True Minds Duseja has a workaround. Invest in passive ETFs and track indices on private companies. Among the ETFs he's recommended to his clients are those from Invesco and HSBC. Such investments are made through the Liberalized Remittance Scheme or LRS, which over the past few years has been a favored route. But investing in stocks or ETFs through the LRS route requires investors to open accounts with intermediaries such as Vested Finance, In Money, or Interactive Brokers. Besides the fund management and brokerage charges, investors also incur forex conversion charges from banks. The cost benefit would work for those deploying a reasonable sum of money eventually, say 5 to 10 lakh rupees, said Viram Shah, the founder of Vested Finance. Also, those investing on their own should ideally be well informed, aware of the stocks or ETFs to buy or sell, and the timing of the entry or exit. This needs some expertise and may not be suited for an average retail investor, Shah said. Another option for those who can invest at least $5,000 is Edelweiss's latest China fund launched through Gift City in Gujarat. Like its other China-focused scheme, this one too feeds into an international master fund. Market watchers expect mutual fund houses to line up more such Gift City-based funds to invest in China in the coming months. These will solve the selection and advice problem, said Axis's Shivakumar, given the multitude of funds in global markets now investing in China. At the other end of the spectrum is Equitas's Far East AIF with an AUM of about $170 million, offering significant China exposure with active investing, all for a minimum ticket size of $1 million. As it stands, the options for the average retail investor remain limited. That is, until the RBI increases the limits for mutual funds to invest abroad or until fund houses find a way around the restrictions. Big ticket or small ticket, when it comes to investing in China, the risks are non-trivial though. There is a fair amount of country risk associated with China, says R. Shivakumar, head of product and corporate strategy at Axis Mutual Funds. Managing the risks. A fund manager described the Chinese government as a, quote, capitalist in socialist form, adding that this comes with the risk of a sudden flip in policy that could again hurt businesses as it did between 2021 and 2024. The Chinese stock market too has been through enough volatility thanks to the high country risk, which is also probably why it commands relatively low valuations. Chinese valuations will likely continue to be lower than the US, said Miresh Srivastava. The returns gap may narrow, but it may not be right to expect valuations to completely converge on a broader level. Despite Trump, the idiosyncrasy and the country risk in the US is lower than in China, said Niranjan Avasti, Senior VP at Edelweiss Mutual Fund. But policy risks and uncertainties are not exclusive to India's northern neighbor. Those can be hedged with well-researched, bottom-up, active investing, said Equitas's Agarwal. Besides, China is increasingly granting foreign investors more access to its stock markets. Programs like Stock Connect, connecting mainland China and Hong Kong markets, are designed for that. Language, too, is not a problem anymore, said True Minds Duseja. Companies that are listed globally or in Hong Kong publish financial statements in English now. Sure, the conditions in China are much better now than before. Yet, almost all the stakeholders the Ken spoke with had a word of caution. Limit exposure to Chinese stocks to single digits, say 5% of the portfolio. Anything above that, as one of them puts it, may be asking for too much risk. That's all for today. If you have a lead for a great story that the Ken can pursue, please send it to tips@theken.com or share it through this form that I'll link in the show notes. To find out more about how to do this securely, read our blog post, which I will also link to the show notes, about sharing tips with the Ken. Thank you for tuning in and catch you tomorrow.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.